Folks, lots to discuss. Number one, the GNS play finally woke up and made a new high this morning. You know what that means, squeeze-a-palooza. Number two, we need to discuss updates on the other important squeeze setups, and there's a few different dormant volcanoes that you're gonna really want to know about. And lastly, number three, an update on our economy. Interest payments on the national debt have skyrocketed to record levels. What does this say about how far the Fed can take interest rates? Let's get right to work. Timestamps down below. We'll start with the lovely GNS. So after an insanely successful squeeze on GNS, we've been waiting for the sell-off to bottom out and get catalyzed to a new high. And well, folks, she did it. We need to hear a round of applause right now for the lovely GNS. Don't worry, she isn't shy. She actually basks in the attention. What happened? Well, we finally just got the wanted catalyst, and GNS bounced up pretty dramatically this morning to a new cycle high at 727. Now, if you recall, we originally briefed on this bad girl at about 70 cents on the 19th, and as of this morning, she hit 727. That's a 10x in a little over a week and a half. Now, a lot of people say, Charlie, there's no use in playing small caps because they're far too risky, but they also can run quite a lot when they have the right catalyst. And that is what we are about. We are about finding the catalyst like we did with GNS, putting them in our daily morning briefings, and making sure to present you, our viewers, with different potential strategies that you could use to take advantage of these. But anyways, for context, the CEO has been fighting a naked short seller battle and is trying to do everything in his power to make life very difficult for them. One of the ways to do that is with a dividend, because when you're sending out a dividend to all shares, well, all of the fake shares also have to figure out how to send out that dividend, and that makes life very, very complicated very, very fast. However, it can't be a cash dividend for obvious reasons. According to the CEO, cash dividends don't work, as crooked brokers would rather pay dividends out of pocket and keep counterfeit shares hidden than have to cover. It's a cheaper cost of doing business. So if you want to put pressure on naked shorts, you have to create a dividend that short sellers can't just go and finagle their way out of. A dividend which is not cash but is a portion of the business, aka a spin-off of a portion of the business. And so this morning they announced the board approved a $37 million spin-off of Entrepreneur Resorts, of which GNS owns 97% of the shares of. The way that this will work is, if this goes through, shareholders of the GNS group will receive an equal percentage of shares in Entrepreneur Resorts. And if there are naked shorts, aka fake shares, out there in the market, the theory is that they'd be forced to buy those back before the spinoff in order to avoid figuring out how to come up with the shares of Entrepreneur Resorts to pay out that dividend. Now, if this was my first rodeo, I'd say, wow, great plan. The problem, though, is that we already know that other companies have done the same thing. You saw that with Ape and AMC. You saw that with MMAT and MMTLP. You saw that with BBIG and Cryptide. Most of the time, they rallied up prior to the spinoff as people hyped it up, and then all of a sudden afterwards, what happened? Well, basically nothing. Short interest was about the same in both entities afterwards, and there was very, very little massive squeezing. The issue is that when push comes to shove, in most cases, your broker really just has to hold the cash value of the newly spun off shares. They don't have to actually hold the shares themselves, and that's not an issue for them unless enough people request those spun off shares. Let me put it to you this way. If I'm naked short 100,000 shares of GNS and they do a spin-off dividend, well, after the spin-off dividend, now I'm still naked short 100,000 shares of GNS, and I'm also naked short whatever the spun off dividend was. In most cases, it's just mechanically the same thing. When a broker tells you that you have a spun off dividend in your account, but there's not actually anything on the broker's balance sheet to back that up, well, that's a fake share. It's really mechanically the same thing as having a regular share short. It's just that now you have the regular share and you have the dividend. And again, this can work because nobody calls the brokers or the market makers bluff. If everybody went and they requested their dividends at the same time, well, all of a sudden they'd have to come up with those dividends. They'd have to come up with all of those shares of the spun-off entity, which is going to be impossible. Probably what would happen is they just pay out the cash value of whatever the spun-off entity was worth at the time. So in and of itself, in my opinion, a spun-off entity is really nothing in terms of doing anything to squeeze short sellers. It just puts a little bit of pressure on them. But, and this is a crucial but, like I said, it can cause a lot of momentum ahead of the spin-off, which that can put a lot of pressure on short sellers. Because remember, every percent that a stock goes up puts short sellers more and more in the red, and makes the position more and more risky. If enough people think that a dividend is going to squeeze a stock, they will inadvertently cause a squeeze themselves by buying into that stock. Now, while we can't necessarily confirm the presence of substantial naked short selling in GNS, it does look like a strong possibility given the symptoms and how GNS trades. But what I am seeing and what my short data provider Ortex is picking up is that the shorts that are easily traceable in this are indeed trying to close out of their positions. You could see short interest has gone down as GNS has calmed down from recent recent highs, which implies what? Well, it implies that if the legitimate short sellers are rushing to cover, then guess what the much higher risk naked short sellers are doing? Well, they're probably also rushing to cover. And I think the more momentum that GNS sees, the more you're going to have shorts rushing to cover on this stock. And that's going to bode very, very well for GNS as this pressure cooker continues to heat up. So I would say GNS right now is really, really in the running for more new highs. If you're going to play it, you want to play it on a dip when it's starting to show signs of recovery, or you want to play it as it's breaking into a higher high with a very, very tight risk management. That's my opinion. Do whatever you want. We are a very high risk channel, but someone's got to cover it, right? And I will be the hero that nobody wanted or asked for. But anyways, folks, since GNS has broken into a new high, you know what that means. It means that we need to bring back the GNS coupon code on ZipTrader U and our daily morning briefings. Of course, we were going to wait until Valentine's Day to bring back a coupon code, but GNS just wants to keep breaking out, so we have no other choice. If it doesn't break out again for 2 or more days, though, it'll be gone. But we have to have a coupon code every time it breaks out just to honor the sacrifice that GNS is pushing on those short sellers. Okay, other squeeze setup. So we just added a new section to our daily morning briefings this morning called Dormant Short Squeeze Candidates. And I want to go ahead and leak the full list for you here today because I believe many of these dormant volcanoes will erupt in the coming weeks. We posted these about 30 minutes prior to market open, and a lot of these have already started stirring, but I think that the biggest moves are going to come throughout this week and especially next week as we get a little bit more past that FOMC meeting. We have Apron, Atter, CVNA, Triple BY, Mara, PXMD, BYND, Upstart, PBLA, WISA, and GNS, of course, on the list. Now, the first one to really pay attention to here is Atter Boy. Atter is a historical squeeze candidate that you might remember from last year that saw some proof of concept this morning and over the coming weeks since breaking above that directional SMA line. I'm looking at it with the expectation that if it can keep retaining these higher highs, it can keep breaking them aggressively. The second one to harp on is CVNA. Carvana is a garbage can company and business model in this environment, but the short interest is in the 60s, and the stock is trying to build momentum and squeeze shorts, just like Atter, and I'm looking for higher highs as well. We want to see it boom through the original 1087 resistance in this cycle. Now, Triple BY. So this is a ticking time bomb to the downside. It's really very reckless at this point to trade it, and I'm probably going to go to hell for even talking about it, and you probably are going to want to be a very big adrenaline junkie if you want to even think about messing with it, because it is going through a bankruptcy reorganization process. But the reason that it's on this list is because I think it has a final massive contrarian rally left in it. Triple BY has always been a stock that has run because it's contrarian, not because people like the company. And what is more contrarian than actually being in the bankruptcy process? Actually going through reorganization that totally screws shareholders when all is said and done. What is more contrarian than having your ticker changed to Triple BY and then a Q at the end, which means that you're now bankrupt? Look, I'm not recommending you trade this. I don't have a position in this, but if you want my real thoughts on this and the real setup here, I think that you're going to have a final massive contrarian rally in this stock. It might be when the ticker turns over to Triple BYQ, and I think at the same time it's going to be because short sellers are going to be super justified in shorting this, so they'll throw the book at this, and then if you get that last contrarian rally, all of a sudden they're going to be leaving themselves open to so much downside. WISA, quite WISA of them. WISA had a reverse split a couple days ago, and it's brought a lot of attention to the stock. Short interest has climbed 216% on this stock in the last 2 weeks, putting short interest at a total of 18% of free float, which isn't insane, but consider how fast short sellers are adding onto their positions and how much the price is fighting back against them, and you could see why it's a setup worth talking about. They are on a collision course. WISA also woke up quite a bit today, so something to watch. BYND did bad today, but it managed to finally break above the previous resistance levels, and if it can build on top of that, I think shorts will have their rear ends on a platter, and so you better get your knife and your fork. PBLA woke up with a 30% plus run in the after hours. I'm telling you folks, this is another stock where it has the short squeeze setup that a lot of the previous ones had that were running, so people are now looking and saying, okay, well, PBLA, that's probably going to be the next one, and so that's why you saw this 30% run in the after hours. They're trying to guess which is going to be the next to run. So our goal in the briefings and on this channel is to find the setups before everybody else finds them and to tell you about them. And that's my mission right now. And obviously in terms of GNS, I am looking for this stock to attempt a new high. I believe the CEO will consistently try to keep momentum alive with this naked short narrative. It's hugely in his favor because it shifts blame away from him for bad stock performance at the same time that it rallies the stock price up. So it's a win-win. In other news, have you seen the federal government's interest payments? Oof, not good, folks, not good. The amount of money the government spends on interest alone is rallying faster than some of the most aggressive squeeze stocks that we talked about in this video. Except instead of squeezing short sellers, well, this is squeezing the taxpayer. But Charlie, how much really is this? Well, in Q4 of 2022, debt interest payments alone totaled $853 billion. How much did the federal government receive in tax receipts? Well, we don't have Q4's numbers yet, but based on Q3's, it's likely a bit more than 3.2, maybe 3.5 trillion. Best case scenario, which means that the government uses about 25% of our tax dollars to pay just the interest on debt that they owe. 25%. You could see debt interest payments dropped as the Fed cut rates in 2018 and into the cough crisis, but now it's skyrocketing as the Fed has, of course, raised interest rates. Now, a lot of people have this misconception that when the Fed raises rates, then that means that all of the government's debt immediately has the higher interest rates attached to it. But a lot of government debt is more similar to fixed rate mortgages. For long-term debt, it doesn't matter where rates go. If the rate is fixed, that particular debt obligation stays the same for the fixed term. This gives the government some wiggle room in a hiking cycle, but that doesn't last for that long. The government has a bunch of different types of debt, short and long-term obligations, all rolling over at different periods, and over time, things catch up. Over time, more and more newly issued debt, short-term debt, variable debt, and expiring long-term fixed debt pushes for higher and higher rates, and thus the higher and higher the average interest payments get. For example, right now, the average interest rate on the total debt is at 2.07%, up from 1.61% last year, but still well below the 4 to 5% you can get for treasuries today. But as time goes on, government will lend more and more out at the higher rate, and the interest payment burden will skyrocket. Right now, the debt is 25% of tax revenues, but at the current rate hike trajectory and timeline, we could be at 30, 40, 50% of tax revenues in just a couple years. And that's not even including what would happen if tax revenues dropped in a recession. Imagine half of U.S. tax revenue going just to pay the debt servicing costs of the massive debt in this country. That would leave us with two different choices. Either number one, we substantially raise taxes and substantially cut spending, which of course, both of those would be politically toxic. Or secondly, the Fed is going to have to lower rates again in order to allow the government to be able to borrow more at more affordable prices and refinance some of its more costly debt. The major reason that rates overall have been on an aggressive downtrend since the 1980s is because we've needed them to be because of sloppy government spending. And this is actually not just in the US, this is around the world. But as rates continue to go up and as more debt is issued at very, very high prices relative to just a couple years ago, well, what's going to happen is the pressure is going to start going back onto the Fed to cut rates, to cut them very, very fast. There's only so long that the system is going to be able to take higher rates. So whether it's a massive, massive recession or whether it's just the practicality of not being able to afford debt servicing costs, well, the Fed can only do what it's doing for so long. So it's something to keep in mind if you think we're never going to get out of this mess. I think we will get out of this mess and then we'll exchange it for a new mess. That's kind of the American way. Anyways, that caps off today's video. Make sure to hit that ravishing like button and subscribe. Sign up for our free ZipTrader reports down below. We're going to be starting to send out research reports to all of our viewers for free. If you sign up with your email down below, you just got to hit that link next to unlock reports. And of course, if you want to sign up with ZipTrader, I'll put the link to that down below. Have a good rest of your day, and we'll see you in the next video.